The 18.6 year market cycle, should you be buying? Should you be selling? And if so, when and how? Hi, I'm Jared Krause. I'm the co-host of Property Pals Australia podcast.
And I'm Sam Powell. And in this episode, we talk to the editor-in-chief of Property Sharemarket Economics, Darren Wilson, just about understanding the real estate cycles and what to look for, and also for those property investors out there, I guess the importance of understanding what you're holding in your portfolio. As Jared said, is it time to sell? Is it time to hold? There's so much value in this episode, as Jared always says, and we had a really long and in-depth conversation with Darren, and I'm really excited to see how this future progresses. And what people do struggle with is understanding, I guess, the bigger picture, and that's what we help with today.
Yeah, we talk about so much about the different market cycles, how the 18.6 year market cycle is basically the economic cycle, and how it's based really off America and why it's so important that it's based off America. We talk about crypto, how that feeds into the business cycle, like stocks, crypto as well. We also talk a little bit about day trading. We talk about where are you at in your property portfolio, where we're at in the market cycle, the winner's curse, and what should you be doing? How can you use this information to your advantage to make sure you set yourself up for the future? So it's such a valuable pod that you guys will no doubt love. Let's dive in. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional.
Audio. Welcome to Property Pals podcast. We've got Darren Wilson, who's the editor-in-chief of Property Sharemarket Economics. How are you going, Darren?
Yeah, good afternoon, guys. Fantastic to be here with you. Thank you very much for the invite. And I'm looking forward to discussing all things real estate with you today.
Yeah, well, property, real estate, markets, share markets, mate. You've got a
name, isn't it? Really?
Yeah, that's why it's obviously getting around to a universal name. But do you want to, I guess, I know of you and subscriber to the Boom Bust Bulletin and Property Share Market Economics. Really great, I guess, information source for me and my journey. And it's helped me have a lot of confidence, because there is so much noise in this world. And it's nice to have a bit of a shining light with you and the team. But do you want to just give a bit of your background, mate, so we can understand, how you've got to be in the position you're in today?
Yeah, for sure. I mean, it's the road less travelled, let's be honest. But my background was I was in the Australian Public Service for a long time, and I spent about 10 years in the tax office as well. And my family thought that was a great career move. Me, I just wanted to learn how to pay this tax, so I went to the source. And I did learn quite a considerable bit in that time as well. But going back to like 2012, 2013, I was actually a subscriber to one Philip J. Anderson. His book had only been out for a few years, The Secret Life of Real Estate and Banking. And at the time, he was with a mob in Melbourne called Port Phillip Publishing. That might ring a bell with some people, but it's an online brokerage house that you subscribe to. And they parted ways about 2019. I had been doing some volunteer work for filling interim, just doing some basic research, chart reading and the stuff. So he grew to know me quite well as a subscriber. And as it turned out, the first class that he held post Port Phillip, I attended that. It was in Melbourne again. And Phil actually approached me and said, look, I want to start up this new business called Property Sharemarket Economics. Would you be able to maybe just continue to volunteer some time and stuff like that? And that's pretty much how it started for me. And then over the years, I just became more and more involved and effectively became just full time with this. And I had to leave my public service career behind. So, that's what's brought me here today.
Yeah, nice. And I mean, you're a bit of a chartist, from what I can see. They used to. Were you more? What was your poison? Was it currency? Was it shares? Like what
No,
was?
I started in real estate
Yeah.
back in 2013, as it turned out. At the same time, I was studying Bitcoin. There was a chap called what was his name? Oh, Max Kaiser. I don't know if you know him. He used to star on RT News, which is Russia Today News, and he was a big proponent of Bitcoin. And yeah, I got to the point where do I want to do maybe crypto or do I want to do real estate? And I went into real estate. I don't regret that whatsoever because that was just more suited to where I was at the time. If I had gone into crypto, then I guarantee I would have lost it. I would have been too emotionally involved and given it all away anyway. So that's when I started. And then, of course, as Phil always alludes to in his books, to his emails to members, you really do need, if you're a real estate investor, you need to know something about the stock market and actually vice versa. And that's why I started many years ago to learn about the stock market. And I mean, you effectively become an eternal student now to this kind of stuff, I'm going to learn a lot from you guys over the time that we spend talking, as much as you might learn from me. And that's just part of the course for this type of career,
Yeah, becoming a product of the environment that you're in, right? Like, I wanted to dig into your experience. Like, you've helped so many people investing for a long period of time. If you were to distill your experience into 3 sort of key investing lessons, for medium to long-term real estate investors, those that are working full-time and wanting to make, retire through property, what would they be? Like, what would your, like, it doesn't need to be 3, it could be like maybe one key one or 2 or a couple.
Yeah, for sure. Oh, no, it's a great question. I mean, there's so many you could pick, but I guess if I was to distill it down to 3. So the first one is you must understand research the 18.6-year real estate cycle.
Yes.
And I think through this pod, hopefully the listeners will understand a little bit of why that's one of the most important things. The second thing is, investing, no matter what it is, crypto, stocks, real estate, really is a team sport. However, you need to make sure that you've got the right people in that team. And one thing that I would stress to people listening is try and find mentors, people who have done what you want to achieve before. These people are not your best friends, but they will hold you accountable for the things that you do, and particularly the mistakes you make as well. And they can certainly speed up the process of getting you from point A to point B, regardless of what type of investment vehicle, say real estate, that you choose to use. And then the third one, I guess, this is more related to stock market, is that the markets are a living, breathing thing, and they hold a mirror up to you. And every kind of emotion, imperfection you bring to the markets will teach you a lesson over and over again, which inevitably will cost you money. And my advice then is, look, stay the course, Make sure you're not making the same mistakes over and over again, but understand that the market is a big mirror into yourself emotionally. And if you can get on top of that, you're going to experience much greater success than when you start.
Yeah, that's some sound advice, mate. A lot of my journey with, especially financial markets was, you start out in shares because it's lower entry costs. I found myself struggling emotionally because it was the ups and the downs. You make $2,000 a day, then you lose $2,000 the next day. I've come to the realization that I am a medium to long term investor because I think short term is it's you're up against people that are doing it every single day. Fund managers and all that. So
I don't know how day traders do it. It's just, you've got to be a very certain type of...
Such a mental toll, right? Like it's like the quicker things move in life and markets, the more stress and drama you can bring into your life. And the more of this, from my understanding, the more stress that you have, the less quality decisions that you make and the more margin for error. That's just a philosophy that I follow in so many areas of life.
Yeah, that's it. I mean, with trading with stocks or futures or CFDs, whatever you choose to specialize in, you quickly learn it's not about profit or loss. It's actually the key secret is your win-loss ratio. If you can design something that gives you a 55% win-loss ratio, I mean, that's a great start. You're going to win more than you lose. And then your job as an investor then, or a day trader, is to continue to refine your system and get your win-loss ratio to 60, and then 65, and then 70. And then all of a sudden, rather than thinking profit and loss, you've actually got a sustainable business that maybe one day you can actually live off. So there you go. There's 4 lessons. There's 4.
I love it. I love it.
Well, this is the I look at it like with those shorter term, whether it's crypto or stocks, right? Like the mindset shift is like you're making a few $1,000s, and then you might be putting $10,000 on the trade, and then 20,000. It gets to a certain level where that extra zero psychologically, it's the same process, but it really affects you, and that's where I just found property is just that. The vehicle, like the wealth is held in that land eventually, and if you're taking that longer term approach, it's a lot more, I guess, I find a lot more enjoyable because there's less stress and emotion involved. But that's, you go on to now, and this is why I love the Property Sharemarket Economics platform, right? Is like it's giving you a roadmap to help see through the noise. For our listeners as well, can you just quickly run through? We talk about every couple of different pods, but the 18.6 year cycle, and I guess the foundational understanding of it, so people can really do a bit more research into it.
Yeah, and kind of like why should people be following this 18.6 year market cycle?
Yeah,
as well?
for sure. Yeah. Okay, yeah. I mean, there's so much I could say.
There's so much. Yeah, we can riff on this for as long as we need.
Try and distill it, but yeah. So 18.6 sounds like a very specific number, yeah. So 18.6 real estate cycle. The 18.6 is the average. So for Property Sharemarket Economics, our focus has always been on the US market. Now, why is that? Simply because for the last 200 years or more, it's the United States that has led the world both into and out of every preceding 18.6 year cycle. Now, on average, it's never been less than 17 years in duration, and it's never been more than 20 years. So the average is 18.6. There is, of course, another more esoteric reason for the number, but we won't get into that today. So the main reason now is, particularly since, I think, 1970 or so, and this was when we went off the gold standard in the United States, and we had free-floating currencies. The numbers involved in each cycle in terms of credit creation, the amount speculated in the stock markets and on land just keep getting bigger and bigger and bigger. And so really, the real estate cycle probably should be called the economic cycle, because that's how important and embedded it is in everything we do. And, I think Henry George, people who follow Henry George are called Georgists, and they call this moment when you see the cat. All of a sudden you see the world for what it is because you put land at the center of your research. And that's something that we help teach and guide our members to do. And then it just frees up, as you say, you remove the noise. You can actually focus on the very heartbeat of the economy. And from that, you can actually time it. And you can time it 10, 20 years in advance, like we've done as well. Sounds incredible at first, but that's actually a matter of fact. You can actually time it. Not perfectly, but certainly good enough for government work. But yeah, it's the United States is the key. You have to follow the United States because it's the biggest in everything. It's got the world's reserve currency. It has the world's biggest military. It has the biggest, most liquid bond market in the world. It has the biggest, most liquid stock markets in the world. The land market is the largest. So it makes sense, Whereas you look at Australia and you look at the United Kingdom, the numbers involved are huge. I mean, they're mind-blowing. The Australian Bureau of Statistics last week released its national account figures for the last financial year. So you're talking $8.5 trillion worth of land value in Australia. And it sounds incredible. I mean, you can't even imagine. But, in the US, it's 10 times that size. So that's why we have to focus on the United States, because it gives us the best timing through the cycle. And then everyone else in the world kind of fits into it. So you generally get about a 6 to 8 month lag for the United Kingdom, and then you get about 8 to 12 months, maybe 15 sometimes for Australia. But that's good news for you, because that means if you follow the US, you'll know what's coming in Australia and you can prepare.
Do you think sorry, Jared.
Go.
Do you think with the advancement of technology and we're all more connected now in this world, do you feel like, is there conversations with the team that maybe that 18 or 12 to 18 month lag period is going to shorten this time round?
Look, anything's possible. Anything's possible. As I said, the timing of 18.6 is an average. So, that does mean that certain parts of your timing might happen very quickly. Sometimes things that you think will happen next year actually happen this year, and you've got to sort of readjust. So, a cycle that precedes this one, it's never exactly the same. Otherwise, why would you need PSE? Everyone would see it. It is always different. There are different macro events that influence it. You mentioned technology. Yeah, for sure. I mean, the way that we digest media now via, social media, your Twitter, now X, and, Facebook and the like, all that seems to do is just increase the white noise and increase the volatility of things. I remember when Silicon Valley Bank, now this is March 2023, I think, that news went viral, online. And of course, we got inundated from lenders going, "Oh my God, look, it's a bank collapse. It's this, it's this." And we just stepped in and said, "No, just wait a minute, ignore the noise. You're talking about a very local, very specific US bank that was basically making idiotic bets in the bond market, and basically, it unwound at a very fast rate. It's not systemic, nor does it affect the US land markets." That was not a popular opinion at the time, believe me, because people just wanted to pile into the bad news bandwagon. And you know what? 4 weeks, 6 weeks, 8 weeks, our advice rang true. That's exactly what transpired, and the cycle kept turning. So, there's a very small example of the benefits, if you know your timing in the real estate cycle, how to properly contextualize things that, for everybody else, just go completely way over the top, and people just get caught up in a narrative.
Yeah, absolutely. And because it's so consuming at the time, and the fear mongering of it all, and then the stress of like, am I going to make the wrong or right decision, and my financial future's on the line? Like,
it's emotion driven. It's emotion driven. That's the last thing you need in an investment journey or stock trading and stuff like that, is the emotion. But we are emotional beings, and it's not easy. I struggle with it myself at times. I really do. So, you're taking the road less traveled by investing this way, and no one's saying that it's easier. It certainly isn't. But I think the results speak for themselves, and you certainly put yourself above 90% of all market participants if you place land at the center of your research and everything that builds around that. Yeah.
It's such a good framework to allow your emotions to, to not get too caught up in your emotions, and to use that as a framework to know where you're at in the cycle. I wanted to ask around how some markets lag others. For example, as where we're at in the market cycle now, coming to closer to the end of, I think they call it the winner's curse.
Correct.
Winner's curse phase. What markets sort of do you see change first and are affected first, and what markets lag afterwards? How and why? For example, is it crypto market being more volatile? That's the one that we'll see the changes. And then does the business cycle lag that? And then in terms of stocks, and then does the real estate cycle lag that? How should we sort of start to use this as a tool for people now that are listening and understand where
That's
we're at?
That's a really important question, Jared. With multiple
variations of the question.
Yeah. So, all right. So we'll peel it back. So let's start. So people listening may have heard the winner's curse. What's winner's curse? Okay. So the winner's curse simply is, if you go to our website, propertysharemarketeconomics.com, the first thing you'll see on that screen, it's dominated by a clock. That's our property clock. Now, between, I believe it's 2 p.m. to 4:30 to 5 p.m., that period of time, we've called the winner's curse, and it relates to the last few years of a real estate cycle. So to explain, 18.6 is basically 14 plus 4. You have 14 years of overall rising land prices, and then you have 4 years of falling land prices. They are interrupted. The 14 years of rising land prices are interrupted what we call the mid-cycle slowdown. In this case, was actually a recession in 2020. COVID, obviously, most people think, but we would do that. So you have 7 years break, 7 years, and then generally 3 to 4 years of falling. So these last few years coming up to the peak in US landmarks we call winner's curse. And it's just simply a term that describes that if you go to auction, leverage the absolute hilt, and you outbid everyone for that dream house of yours by about $500,000, you're probably better off not have winning the auction. You're cursed now because your margins for error are basically non-existent. And when this thing breaks and it snaps, you're the first people that the bank are going to hound to death to cough up $500,000, $600,000 in collateral, or they're calling the loan in. So it's called colloquially a winner's curse.
Can I offer just before, I don't want to butt in, if I may offer
Sure.
An example that I got from a friend of mine, and how how you can adopt that mindset of a winner's curse. His name's Jason Pizzino. He helps people in the stock market. He's an Aussie guy.
Yes.
And he also, I heard about the 18.6 year market cycle from you guys, Darren, from Sam, who told me it's from you guys. And then Jason also uses his 18.6 year market cycle as well. And I was over at his house many months ago, and he mentioned, like, I was just talking about putting some money into crypto.
Yeah.
Because the 18.6 year market, it's an economy cycle, right? So he said, what most people end up doing is they see the market doing really, really well, and then they, instead of putting most of their money in at the start, say for example they got say $10,000, instead of putting like $8,000 at the start and then just putting like a little bit more in as it goes, what they'll do is they'll put in $1,000, test the market, and then they'll go, oh, that worked well. They'll put in $2,000 as it starts to go up and up and up, and they'll put like maybe like $4,000 to $5,000 or $6,000, and that their last sort of, like, they see it's crushing it, so like, I've got to get in now and put most of my money in now. But being the winner's curse phase, you're putting most of your money in at the top because you have seen that you've started to win over a period of time. And if you don't understand the cycle, that's when it's like, boom, you've invested so heavily at the top of the market, like you said, going to auction, seeing, maybe you're not already invested in the market with the property, but you're seeing everybody win, you're getting mad FOMO, and you invest at the top. It's such a...
Yeah, perfect. No, I can't add anything more to that. And, Michael and Jason Pizzino, great guys, very humble, thoroughly endorse their work. So, yeah, I mean, please feel free, you listeners, to check them out. I mean, it's good to have, many different sources of information. Can recommend those guys. But yes, as you're saying, like, so, within the winner's curse, you've said, so what markets do better than others? And, during this time, the volatility starts to really ramp up. But there's something else that occurs, and most people either don't see it or they choose to ignore it. But when speculation really starts to take off, you get this split between things like your crypto markets and real estate flipping and the stock market. They all go up, but the real economy, the things that are productive and important for us, start to show significant stress, right? And that's happening today. It's been happening now for over 12 months. And it's your first sign globally and in Australia, land prices simply are too high. It's too high. There's too much pressure being placed on productive businesses to be able to maintain sufficient business margins. So things start to break down. But the problem is, I'm sure you saw it the last week or two, Bitcoin hitting 100,000 US dollars per coin.
Right.
And you see the news that comes up with that, that dwarfs bad news that comes out, like about, we're still not building enough homes, and oh God, I mean, people are just already struggling under mortgage and stuff. It gets swept aside. Like, the newsman's not interested. Give me the flashy thing that we can just, go viral and put our clicks in and get all the attention that we want. So that that's what happens in the last couple of years now. The speculation really turns up, but it comes at the expense of the real economy. And the real stress marks don't show up in your cryptos and stock and stuff. It's actually the everyday stuff that you and I rely on to live a quality standard of life. I was in Brisbane not that long ago, and I couldn't believe that local parks near a place that I own up there full of tents. Who are these people? What? And my sister-in-law told me, that a couple of years ago they weren't there, but they've got nowhere else to live.
Yeah.
I've got the supermarket just down the road here, and there's the beggars there now are just there every day looking for money and stuff like that. I mean, I don't want that kind of society around me. I don't want people to have to suffer like this. We've made our bed, we've got to lie in it.
Yeah, and then the media too aren't sort of telling those stories either. Like, it's a bit of a, head in the clouds, misdirection, and you can see we're seeing it unfold, as it today, where we talk about Joe and I constantly about social media, and people don't want to hear those stories of just everyday people that they're not living in tents because they can't afford rent. They just can't find a place to rent because there's just not enough supply in the market. And then that's been a lag-on effect because obviously working in the property industry, like I've seen it come forward for years. There hasn't been enough initiative put forward to, I guess, think this through, or maybe they have in greater detail, and there's an underlying agenda for the future of rent to live kind of scenario. It's pretty crazy.
No, yeah. It's an appalling state of affairs, and governments are the most predictable thing. You know how they're going to react. They always do. They back the land market. They did it in 2020 and stuff. They made sure that the money they were handing out, and they collaborated with the big four banks. They made sure that covered the majority of mortgages those banks had on their loan books. That's where the figures came from. That was to support the land price. They didn't want to run on real estate because people just flood the market with properties that they can't afford to pay back.
Yeah, it's just unstable for the banks. It's in the banks.
Yeah, that's it. And now it's the opposite thing. You've got now the government's predictably coming out and pushing more incentives and stuff to help, your first home buyers buy new and existing homes. I think something passed in the Senate recently for 40,000 new build homes. People can get significant discount in the deposit they need and all that kind of stuff. But it just ramps up the pressure.
It does.
The land takes the gain instantly.
Yeah.
Instantly, you're not gaining anything here. This is a zero-sum game.
Yeah,
the government don't hand this stuff out, and then somehow you've just gained an edge over other people. It doesn't work like that. That is not the economic science that underpins the land market. And the reason is because we have decided, as a society, that we would rather let the banks own that, and then let them lend money to you and me, so we can outbid someone else and keep driving it up.
Yeah, it's a massive shame that it's just putting people in a bit more of a, like, people that can't really afford to get finance are able to get finance, even though they maybe should not be getting finance.
Precisely.
At the specific time in the market cycle, which just fuels to it making life harder for them if they don't have other resources to back them in harder economic times, which is scary. So back to that then, like where we're at, how do we read this correctly for somebody just new to this 18.6 year market cycle and where we're at and what to kind of do? Do we look at the volatility of the crypto market, and then that the business cycle lags that in terms of the stock market, and the property cycle lags that, and then what do we do? Like, how do we read this now?
What leading indicators is that? Kind of the question?
It's always land. Always land.
Okay.
Land must be first and foremost at the center of your research. If you want to know the timing, if you want to know how the economy's trading, it's always land.
Okay.
I know you've mentioned crypto quite a bit. I mean, at first we PSE, we struggled with trying to work out how does Bitcoin et al. Fit into a real estate cycle, and it wasn't clear at first. Certainly when I first studied it back in 2013, it was being pushed as an alternate currency. But you started to see the mainstream banks and stuff get involved, and that dream died very quickly after that. There was no way that it could ever be an alternate currency, and you've got Wall Street coming in and basically taking that away. It becomes purely a speculative tool. So the parallels that we've managed to draw over time looking at it is that something called global M2 money supply, which is just basically brand new credit created by central banks and governments globally called M2 money supply, is heavily linked towards the performance of Bitcoin. So when the printing presses are on and stuff like that, you'll generally see strong moves to the upside for Bitcoin. And when the Fed decide to take that away or there's a hiccup in the system, Bitcoin can retrace. And so for us studying the land market, all of a sudden, at this time of the winner's curse, the real speculative phase and stuff like that, Bitcoin's warning signs now ring much louder to us because of what it represents and the type of money that it's pushing it. It's just 100% speculative rent is Bitcoin. You take gold and silver. Gold and silver have a price. That's right. Could gold and silver ever hit zero? Be worthless? It can't actually, because they actually have a utilitarian value as well. Exactly. Silver is used in jewelry. Gold is used in it. Used in electronics. There is a hard floor underneath commodities like that because there is a legitimate productive use case for them. They can never go to zero. Crypto can. You can do it probably in 24 hours. It's just pure speculative rent. And when I say rent, I don't mean rent that you pay to, say, a landlord. I mean the natural rent that emanates from the productive qualities of a society. It's best manifested, obviously, in the price of land. In Australia, I think historically, it equates to about a 5% on average rise in land values every year. Obviously, that changes, but on average, it's about 5%. And that's the productive qualities of our society going into the land price. But, something like Bitcoin, I mean, Elon Musk can say something on X and it can jump 20%. It's like, why? What fundamental reason drove that? Oh, it's just a tweet.
Yeah, it's great.
Hey, it's good when you're on the upside, but when it snaps as well, I mean, you've got no chance of locking in profits if it's going to move that quickly,
Yeah,
but it does. It is. I'll just wind this up. So Bitcoin is specific to this cycle. We've never seen it before, but its true role within the cycle, I think, is now starting to manifest. And all it's going to do is heighten the volatility and the emotion of these last few years of the cycle. Does it survive? I can see some of them surviving in some respect, but I think the overwhelming majority will probably never see again once this peak in the next few years turns to a crash. But again, that's my opinion, and we all have opinions, and we'll have to see. But the link between Bitcoin and the land market, very interesting, and I think so far it's holding up, but we will continue to watch it closely.
Yeah, can you lunar cycles and things like that? Do you, I remember reading some of the research papers that Phil was getting involved in. There's there's the commodity cycle, there's a business cycle, there's the election cycle. This is the level of detail that PSE go into, right? And then even I did touch on it. There's the different, even in the shares, right? There is trading around lunar cycles. Then it goes into a little bit more of a my different thought process of mine is that everything has there's patterns involved, right? Like that's the fundamental, element of our world where even trees, they go through, they grow and then they die and then they get reborn again through all that. Do you have much knowledge around sort of that lunar cycle and how that links up with this 18.6 year theories?
I do. But if I start talking about this, is when people will tune off.
I think it's a bit woo-woo, but I mean,
it is a little bit out there, isn't it? It's the esoteric sort of timing, But look, I mean, PSE didn't invent this cycles research. We've always had it. It's just for whatever reason, it got written out of the economic text many years ago, quite deliberately, and people just forgotten about it. But you go back not that long ago, cycle research was a fundamental part of your economic degree. If that's something you wanted to study. Certainly, we were a more agrarian economy. So we were highly reliant on the seasons and how they affected, the agriculture that we grew and everything. So that lent itself to knowing, well, how do the cycles affect it? Do solar cycles affect what we grow? And, actually they do. Do lunar cycles do it? So this all fed into a thesis, a study that was very broad and could be applied to the economy and could help, governments make long-term decisions on the things that they would grow and put money into to help, so that now we're a more technologically based society, and it's just, what have you done for me lately sort of thing. And we just don't think or acknowledge these natural cycles that have always been there. But we are poorer for that, our lack of knowledge. So this is the fine line that someone like us at Property Sharemarket Economics, we try to highlight just how badly economics has been treated. And we also try to say, well, look, if you can't beat them, maybe you can join them. And this is how you can use this knowledge, you can have a wild argument at a barbecue about how unfair it is. That's fine. But at the same time, you can also take that knowledge and say, well, look, maybe I can set my family up here. If I use this knowledge about land, maybe we can find a good location and maybe sit on some good property or, farmland for the next 10, 20 years. And I can use this cycle to time when we buy and when we sell. So we walk that fine line of just saying, we rail against the system, yes, but at the same time we show you how to take advantage of it, because you might as well. If you've got that knowledge, you are undermining yourself and your family by not then taking it out to the market and taking full advantage of it. So we're in that sort of grey area, and sometimes people throw one side of that against us to say, well, you don't like governments, you say they do the wrong things, but here you are saying, you should take advantage. Well, that's just the nature of the business,
People are always going to, be happy or unhappy based on their own stuff, and that's got nothing to do with what you guys do. And so, you've got the government that moves in a certain way, and if you understand how it moves, and the economy moves, then use it to your advantage, like you said. Talking about using that to our advantage during, coming up, like, it's very rough. It's an average, right? The 18.6 year you mentioned is an average. We don't know exactly when the tip of this winner's curse is, and then we move into a possible downturn.
We don't know yet. It's too far away for us.
Too far away. Do you have a range? Do you have a range that's like maybe 1 to 3 years?
Well, certainly, if you put the US front and foremost in your research, it does appear that things are lined up for a 2026 top in US land markets.
Okay.
And I'll come back to a point that I made much earlier in this, was that people who are investing in real estate really should learn a little bit about the stock market. Here's an example of why. If your forecasts gives you a certain time period or a date that you should be looking out for, then one way you can validate that is by reading the stock chart. So I can tell you, come 2026, myself and the team will be studying very closely certain select US property developer and home builder stocks, because the market is the ultimate discounting machine of the future, and they rarely get this wrong. And if they start to ascertain that these companies who obviously are buying land to develop at the absolute peak of their cost, when it becomes financially unviable for them to do so, then it's going to affect the earnings that they can create. And the market works that out, and you see that in the stock chart. They start making what we call lower tops. So prices start to fall. It's not instant. It's not on a day or something. It's a process. Yeah. And you'll see that build up if you're following the correct charts at the right time, which we'll certainly be doing come 2026. And then that gives us a bit more certainty that once they start to fall off, we can look back at what happened, say, at the same time last cycle and the one before, and then start firming up our time date for then the ultimate peak then bust. Because what you're going to see is, as land prices start to fall, happens gradually, slowly, things start to break on the margins. Now, they don't get reported on it and stuff, but that's the beginning. It's the match that lit the wick that slowly burns towards, igniting the full-on bomb. And you'll then have, though, the stock market overall, the stock market continuing to rise, but stocks that are land exposed They aren't following that general trend.
Are you talking about like REITs, real estate investment trusts?
You could follow those, but unfortunately, because of the idiotic decisions governments made in COVID, they broke the back of most REITs, unfortunately, because they just put them in a position where they just couldn't get the rents to justify the amount that banks were asking them to pay for the loans that they had. And a lot of them have just fallen apart over the last couple of years and never come back towards their previous highs.
Right.
Certain select ones, for instance, REITs that are exposed to, say, data centers. We know the importance of data centers in a technological society and the birth of true, general AI. Those ones probably will hold up very well, but we want to be really specific come the time of the peak, and it's because we've got the history of them. There are certain select US property developers that we will be watching, and they should give us very good advance warning that the land market peaks are starting to come in. And then we can turn to our property clock and we can mark that out, and then we can start timing now. So we've got this amount of time now left for a potential blow-off top for the stock market. And then, of course, the credit crisis that comes up as I said, starts on the margin, starts to work itself into the centre. We start seeing the tide come out and seeing how many people have been swimming naked. And come the peak and bust, it's the majority of people, So it'll be interesting times.
Sam's got a great question here around that, like, the market cycles, and then during a 4-year downturn. Is it smart for retail investors to try and seek out gains during this period, or is it wiser to just sit in cash and wait for better opportunities?
Well, that comes down to your experience.
Yeah.
The world that we see today is completely different when the peak turns to a bust.
Mm.
Now, if you weren't cognizant of this stuff come 2007, 2008, 2009, you might have been too young, maybe you're in high school or something like that, and didn't take much notice. I mean, life generally just went on as per normal, But if you're invested in the markets and you now have a seat at the table, it's a imperative that you know what's going on. So, my motto, and the one that I try to give everyone who subscribes to the things that I write about, is profit but protect. So, yeah, you can profit, but don't forget that you also will need to protect. Now, there are some people who are probably excellent traders who understand how to really go hard and short a market. They may do over a brief period very, very well. But for the vast majority, really, the time to start going from the profit mindset to the protect is actually now. And have you heard of a term called contrarian, where, when everyone's bullish, you should be bearish? Yeah.
Yes, of course.
So for the vast majority, if you're not very experienced and have a good, like a high level of emotional intelligence, and I don't mean that in a bad way, but I mean it as a good way, because you're experienced, you've got the scars to prove it, It's probably a good time to start really hedging yourself against the very worst, and positioning yourself for the start of the next real estate cycle, where there will be, regardless of what type of investment you're looking to get into, bargains galore. And it's the people with cash that basically can set themselves up for the next, 18 odd years of rising land prices. Or do nothing. I mean, that doing nothing is also a worthwhile strategy. If you're not sure, you say, well, I'm just going to go into cash. I'm not going to do anything. I mean, that's a legitimate one as well. The last thing you want to do is do something just based purely on emotional because you saw someone else do it,
Yeah, it really depends.
That's going to trip you up.
Yeah. There's so many factors to consider for somebody that's investing in real estate. Say they've got a portfolio, but depending on where each property that they own, where they're at in that cycle for each area that they've invested in that property, and when's the right time to sell or not. There's so many variables. But say, for example, somebody's got a property portfolio. Maybe there are one property that they could sell and then cash out and hold it and wait for a couple of years, or maybe it's a couple, or maybe they've just they've bought through COVID and they've seen some growth, and they might just allow that to stay in there and then allow it to sort of trickle drop down a little bit and then just hold it all the way through, right? There's so many different ways.
Yeah, for sure. I mean, if real estate investing is a business, that's your business,
Yeah.
and any business that wants to be successful, is not going to hold for long underperforming assets. You're either going to liquidate them or you're going to do something to improve them.
Mm.
So, I mean, if I owned a penthouse opposite Bondi Beach and I wake up one morning and the recession has started and the bust has happened, I'm not going to wake up, get my coffee, open my curtains and see a view that looks like Alice Springs. I'm still going to see the beach, right? Location is key. Regardless of whether we're in a boom or a recession, that location is very valuable. And you can only sell it once, yeah?
Yeah.
And you may not be able to get back in if you're thinking, well, I'll just sell, come back, and you may not be able to, all right? So you need to be really selective about what you're going to sell. And I'll give you two reasons why. Number one is that when you sell, you effectively take yourself out, and this happens in Australia because we have advance warning of what's coming. Yeah, I told you that we had, maybe 12 months, sometimes 15 advance warning. The government, because they did it last time and the year before, they will come in with packages designed to support land prices. And you'll find that last time the rebound in Australian property was at what they call a V shape. It went down and then it just bounced right up. Now, if you sell, you miss that. You've got to take a step back in perhaps your capital gains that you've got, but you also preclude yourself from making rebounds on the way up, particularly in the very best located properties. So that's something that you need to weigh up, and only you can do that. But the second thing is, if you have poor performing, assets, like, I don't know, maybe you own, some apartments or something in maybe a couple of the big CBDs. Now, because of the immigration policies, they've caught bids. People are striving to get somewhere to live, and you can get really good yield from them. But don't be mistaken, they're going to be worth a lot less. Take this time now to actually just sell out into a rising market when things are, and then take that money and perhaps put it and hedge it against the other quality parts of your portfolio business, and give yourself an additional equity buffer by putting money in there. I mean, you can pay down a loan. Maybe you can put it in an offset account, give yourself some flexibility, particularly if your strategy is to ride out the downturn, but then release a whole heap of equity and just go out and buy a whole heap of bargains in places that you've been looking at right now, but are just too expensive. Right. I mean, personally, Phil's book, and I've got it here, Secret Life of Real Estate and Banking. When I first read this book back in 2013, when I got to the last page, the first thing that popped into my mind was the best time to buy real estate is in the first half of the cycle. Now, that's not good advice right now because we're in the second half of the cycle and quickly approaching the peak. But this is the great thing about real estate. There's many different strategies, many different ways that you can play it. And even if you make mistakes, and I have, with purchasing and stuff, if you're disciplined and you understand your real estate timing, thanks to a book like this, given time, your mistakes can turn around and you can all of a sudden be holding a high yielding, very well performing property, rather than taking an emotional decision to say, I screwed that up, I'm just going to sell it. So property can be very forgiving, and there's many different ways that you can play it. I just explained something that was personal to me, but that may not suit people at the moment, And I do understand that right now there'd be people who are interested in entering the market. Again, if it's for your own principal place of residence, I say go for it, but understand the risk. The margins of risk are very, very high at the moment. Make sure you have a robust and scalable plan to build some serious equity in that place of yours so that you can protect yourself from the worst of the download, But if you're trying to build an investment portfolio at the moment, your problem is getting the finance. It's going to be some of the biggest mortgages you're going to apply for the last 20 years. You've got significant investor and overseas interest in the very best properties, and they will be outbidding each other to get them. And then, as I say, by the time you sign all the paperwork and hand it over, you've got a massive amount of debt and not much time before the whole land market takes a turn for the worse. So yeah, timing is very, very important as in location, a good location. I would be very reluctant, even if you know what's coming, and our members obviously will know and will be guided through that as we go. If I've got a really good location, I'd be very, very loath to let it go. I'd actually be looking at other strategies to hedge myself so I can ride out the worst of it, because it's those very best locations that will instantly rebound when the worst is over. We start seeing gross rents start to rise again, then your net rents. And this is the first key, the 1 a.m. of the real estate clock. The next cycle's starting to commence again, you know.
Yeah, that's why I go like the last few years, people, even the last, because like last 10 years since 2012, 13, sort of towards the bottom of the market, we've seen so much growth, and people have this, false narratives that property always goes up. And that's why the education on our end is really, if you're going to buy property, focus on the best markets in Australia based on, good quality location research and data, but, also make sure you're getting that, I guess, your cash flow element to help you, hold that portfolio through any struggling times that are to come. Because, with the right level of cash flow and the right asset, you can capitalize, and that's where, there's always downturns, right? Like it's the cycle nature of property. It's just making sure that you're going in with your eyes wide open and having the right strategy, because no longer is it going to be throw your money at a wall and it'll go up in value. That is just not correct. And I think that's the message I'm trying to help people with. And your knowledge helps me share that with people. But also, like, I think a kill second, what you just mentioned too, is just having those good quality assets, not being fearful, holding through that period, but making sure that you're thinking a few years ahead. You want to have that income security. You really want to be gearing yourself up with a good quality cash flow in your household and portfolio budget. Because I'm excited, mate. I'm excited to go shopping and not compete against the troves of people that are out there at the moment. And buy good quality assets at the bottom of that cycle and enjoy the next 18 years that's to come. And that's all you really need to do. It's pretty simple, but most people struggle with the simple stuff because they want the dopamine hit of short-term, inflections.
That's my other colleague, Akil, Secret Wealth Advantage. I might as well plug that book while it's there. Really good book if you want to know what to do and how to structure yourself for these last final years. Akil goes through all that. So highly recommended book.
It's in the back there too, mate.
Yeah, I've seen it before.
When's your book coming out, Darren? What's going on?
Right. Look, I probably will end up writing something. It just needs to fit in with these ones. Like, it needs to be useful. It needs to be something that you can take for the next 18, 20 years, and it builds upon this one. So yeah, it's something Phil has mooted to me a couple of times. I'll need to sit down and nut it out with him. I've got a broad outline, but nothing's really fully committed yet. But watch this space.
Yeah, well, maybe it's how to take advantage of during the down period and what to focus on for assets. Just giving you a few ideas. I'd love to sort of read that one. As
long as it's useful, it's got to be useful. It's got to be something that you would pick up, not just once, and you could just refer to it over time, like Phil and Akil's books are turned out to be. Constantly referring back to them. If I could produce something like that, that would at least be useful, and it'd be worth someone's time and money to sort of get it. But yeah, back to the real estate. So yeah, as you're saying, it is real estate is your business. You need to have an understanding of your internal rate of return, your cash on cash return, because this then dictates what quality of asset you're actually holding. And also, do you have capacity to increase those by maybe putting in a little bit of money to renovate, or put in a pool, or do something to that's fairly would be expensive today. I mean, there's no getting around. Anything you do with a house would be expensive, but it would give ongoing benefits to capital growth for that sort of property. Whereas the other side too, if you have got a poor cash on cash return and the internal rate of return, the yield's not good, you've got an underperforming asset. Well, using your timing, that it's best to sell that now rather than wait 2 or 3 years when the market is flooded with tens of thousands of, shoddy built apartments. And that's another thing too. The build quality.
Yes.
The build quality of new stuff now. And look, the construction industry's had a really rough time and many people have been hurt. And I am not in the business of making light of them. A lot of them come to us as like members, you know what I mean? And they've done it very, very tough. But the fact is that the build quality right now is probably some of the worst in the last 20 years. And it's simply because land prices are too high. The only way builders can produce some sort of profitable margin for them as an ongoing entity is to cut corners because there's just no choice. Land, you can't get a bargain on land, so you make the cuts elsewhere. And so the quality of these places that are being built, they look nice on the outside, but if you go into like an apartment block and go down into the underground car park, just look up and look at the quality of the piping that's on the roof. Go and open the fire safe doors where the hoses are and look at the quality of that work. That'll give you some idea of what's behind the facade. And you do not want to be.
I noticed that. I personally noticed that when I was in the construction industry as a plumber. Like, it's just seeing car parks now compared to what I was building, in 2007, 8.
Yeah.
Very, very different. Yeah. Yeah.
And some people, like a lot of them, look absolutely spot on. And then you're dealing with a quality builder that's put the time and effort in. And therefore, you might be paying top dollar, but you are buying a top dollar asset. This is something that will perform for you for 10 years, 15, 20, you know what I mean?
Yeah.
But at this time of the cycle, with the pressures that are on, they are few and far between. The vast majority are just not. I mean, the unit growth here in Canberra, that's where I'm coming from you today. You're starting to see, you've got to dig to find this news, but there's some places where people are being told, look, sell, we're going to do a class action. I know someone personally who has their body corporate has approached them and said, look, if you want to take this guy class action, we're going to need to increase your body corporate for the next couple of months by 200-300% to just afford the lawyers to get the ball rolling, on this stuff. It's starting to happen here in Canberra, and the government is really pushing for certain developers to make those types of things, in some of the big population centres that we've got north and south of Canberra. But for someone like me, I just run my eyes and go, well, here we go again. It's just yet another sign of where we are within the cycle, and you couldn't pay me enough to buy one.
Yeah, guys. Sorry, Sam, go on.
Yeah, we're big proponents of don't buy units new, especially. If you're going to buy a unit, it's going to be an old, established with future development potential and a small walk-up, low-body corporate that's stood the test of time. And yeah, you don't know what you don't know, right? And that's why we love getting people like yourself on, Darren.
Yeah, thanks so much, Darren, for your time. Guys, check out both those books that Darren's recommended, and we'll link to you, Darren, for sure. Yes, thank you for putting them up there. We'll link to you.
Akil will be very chuffed with that.
I love. I think Akil's done a really, really great job in his book this time around. Phil is a lot more. It's a lot more dense, and it's a really interesting read. I think everyone will get value out of both. So we'll put some links in there.
Yeah, definitely. The big picture is Phil's book. Very heavily focused on the US, but again, I've explained why that is. You can't time the cycle without starting with the United States. That's mainly Phil's book. And then how do you play it is through 18 chapters, 18.6 years, 18 chapters of Akil's book on practical ways you can play it and the signs to look for that that the cycle is turning on time. So, really highly recommended books. And, like Akil, Property Sharemarket Economics has given this guy the platform that his work deserves. No one will take anything away from Phil. He's sort of the doyen. He's up there with your Fred Harrisons and Mason Gaffneys of this world. His stuff will go down as the legacy research on this topic. But yeah, Akil's work is getting the widespread acclaim that it deserves, and I'm ecstatic for his success with the book, because I know how hard it took to write the damn thing. I'm probably going to experience that myself soon.
Yeah.
I'd also call you
those guys. I mean, check the books out, guys. We'll put a link to Property Sharemarket Economics as well in the show notes. And yeah, Darren, thank you so much for coming on. Appreciate your time.
No, thank you very much. Just one more plug before I go. If anyone is interested in our work, if I can suggest, we have a free weekly newsletter. It's called the Property Cycle Investor. There's no obligations. You can unsubscribe from it at any time, but it's a weekly look at the things that are moving the real estate cycle. And it's a great way to introduce yourself to our research and why the land market is so important. So if you go to our propertysharemarketeconomics.com website, simply look at the menu at the top that says blogs and just go through, read the archives. If you're interested, just click the link to subscribe. Easy as that.
And the Boom Bust Bulletin, mate.
Yes, that's the other thing that I write. That's a monthly edition. It's an introductory type of product. And I tell you, it would have saved me years and years of labour and research if I had something like this when I first started out, like 11 years ago or so. So it's our introductory offer. It teaches you the basics of the real estate cycle, why it has the time it does, how it turns, how it affects different markets. It also provides you a introduction to stock markets and chart reading and why they're so important. And the idea will be that once you've spent some time as a BBB member and you're keen to learn more and you're ready to start your journey, then it's time for you to progress to a full PSC membership where you get everything from Phil and Akil's research as well as my own.